Hi guys, David here from Critical Trading. Thanks for joining me in today's video. Now, do you think that we small retail traders actually have any sort of advantage over the smart money? So the professional investors or the institutions that possess significant amounts of capital. Now, when it comes to trading systematic strategies, meaning that you trade strategies that can be written in the form of a code in different programming languages, which is what I do, there's no point of even starting to think that we can possibly compete with these individuals or institutions in any way that's trading related. What I mean by that is either skills or industry knowledge or know-how. There's no point of even me as an individual investor starting to think that I possibly have something more that these guys have. They're probably much smarter than I am, and they have much more capital and much better computing power. However, there is one advantage that's not very well known, because most beginners focus on individual instruments, and you kind of only discover this advantage when you possess the skills and tools that allow you to analyze bigger data sets. And I'm going to tell you what that is in this video. Before we get to that though, if you're new to my channel, my name is David and I make high quality videos about systematic and algorithmic trading that can truly help you to becoming a systematic trader. If this is the kind of content that you're looking for, then have a look at some of my other videos and consider subscribing to my channel. By doing so, not only are you helping me a lot, you're helping other people as well that will be able to discover my content and potentially learn something new themselves. To demonstrate what I mean, let's just go over a trading setup of one of my strategies that I'm currently developing and will be shortly included in my own systematic portfolio. So this is a mean reversion strategy, but it's a little bit different than your typical mean reversion strategy. Actually, I've already talked about it in one of my previous videos, but let's go over a typical setup very briefly. Basically, what this strategy does is it waits for a breakout of N-day high. In this particular case, it waits for a stock price to break above the 5-day highest high. And then after that, it tries to aggressively buy below the low of that day at which the breakout takes place. So somewhere at this price, for example. So in this particular case, this strategy bought on this day here, very close to its low. And the strategy then sells at close of the same day. So this is essentially an intraday strategy, but that's not very important. What is important to take away from this particular screen is the fact that the day at which this strategy bought is very volatile, and you can see that on the range of that candlestick or on the range of that day. We can see that the price went below the prepared buy limit that this strategy works with, and then made a huge intraday move and ended up closing higher than the previous day. And this is very important for this strategy, but I'll get to that later. Now, I trade this strategy on all stocks that belong to one particular index, okay? And that is very important. This strategy trades all stocks that belong to Russell Micro Cap Index. But let's just have a look at the backtest results of this same strategy, but applied on all stocks that belong to S&P 500. So this is a very different, what's called a trading universe. S&P 500 are generally, the best companies in the US, very high market cap, very stable companies. And so the prices of their stocks generally are much less volatile than some of the cheaper stocks that do not belong to this index, but for example belong to the Russell 3000 or Russell Microcap. And the interesting thing about this is that if I backtest this strategy on S&P 500, we can see that this strategy actually loses money. So this is not a working strategy. The reason it loses is that the win percentage is just under 50%, which in itself wouldn't be an issue. However, the average winning trade is actually just slightly lower than an average losing trade, which in turn makes this strategy a losing proposition, essentially. The thing that most people do, they would backtest this strategy on S&P 500, then they would conclude it doesn't work because obviously it's losing money, and they would scrap it and conclude that the strategy doesn't work. And, in most cases, it is the correct conclusion. However, you really need to look at not only the strategy itself, as in the buy and sell rules, but you need to consider what are you actually trying to trade with that strategy. Now, going back to this strategy, this is a mean reversion system. And as such, it will do well in periods of high volatility. So the higher the volatility, generally the better for mean reversion systems, even during the bear market. When we go back to the S&P 500, obviously S&P 500 would include mostly lower volatility stocks that are generally quite stable, especially when compared to micro-cap Russell stocks. And we saw this at the previous screen when I pointed out that the range of that day at which this strategy bought and sold was very, very significant. And that's exactly what this strategy is essentially trying to capture or exploit in the market. And when applied on all stocks that belong to S&P 500, it simply doesn't get to exploit that much, because in general, the stocks that it would pick to trade do not offer that high volatility. So let's take the exact same strategy, do not change any of its rules, and only thing I'm going to change is the universe that I trade. So instead of picking just S&P 500 stocks, let's test it on Russell 1000, Russell 2000, Russell 3000, and finally on Russell micro-cap stocks. And the results belonging to all these different universes traded with this identical strategy are shown on the screen. So we can see the bottom results are the ones that I showed before on S&P 500, strategies losing money. Russell 1000, strategies still losing money. But then when we get to Russell 2000, strategy actually shows profitability. And as we get to Russell micro-caps, this system actually shows a very promising profitability. And some people would actually argue here that I'm doing what's called curve fitting. So I'm basically trying to fit my backtest to work by changing the universe. And of course, I can never guarantee that that is not the case. And, you know, the strategy is going to be profitable going forward as well once I take it live. However, I would argue that this is not in fact curve fitting. This is basically trying to exploit or take advantage of the fact that different stocks offer different volatility. And all I'm doing here is I'm trying to focus on the most volatile ones, because if you look at the typical mean reversion system, actually the high volatility has positive impact on mean reversion. If on the other hand you were working with trend following system, then you would typically see inverted kind of phenomena here. So in S&P 500 you would probably get highest returns and lowest drawdown, and as you would go and trade lower price stocks with lower volume and lower market cap, you would probably see the strategy losing money. So this is essentially just understanding the fact that different stocks behave differently based on their volatility. And the final iteration of this strategy with the backtest results right at the top of the screen is what I'm trading myself. And this is the advantage that we have over the smart money, because generally stocks that belong to Russell microcap are very low liquidity. And so the smart money, the big institutions that are trading millions of dollars, would not be able to trade these stocks. So they're generally not interested in these kind of stocks. And there is a little bit of an edge to be had when it comes to small investors, because we can still trade vast majority of these stocks that belong to the Russell Micro Cap Index. So for example, if I go back to the particular stock I was looking at right at the beginning of this video, we can see that at the day that this strategy entered, the volume was about 100,000 shares. So it is still possible to trade. Obviously, going back to the backtest results, you would not be able to compound this kind of strategy in these low liquidity stocks for years, of course. So the backtest here is just a rough estimate, but still the smart money, the big institutions with big capital are not going to be active in these stocks, which is exactly the advantage that you or me as small retail investors have over them. And let's just go over the equity curves as well. This is the equity curve of this strategy when applied on S&P 500 stocks. And this is the equity curve that belongs to exact same strategy. So no rules have been changed whatsoever. Commissions are included also, but this strategy now trades all stocks that belong to Russell Micro Cap Index. Obviously, the historical index constituents were taken into the account. So I hope you found this video helpful. Hopefully it provided you with some kind of inspiration that you can take away for your own trading. Thanks for watching. This is David at Critical Trading, and I'll see you in the next one.